VP of finance for a Fortune 500 insurance company. I worked on Wall Street for a little while in Manhattan. Went to UNC Wilmington here, actually. I don't have a 4-year degree. I'm not a CPA. I'm just another guy that hustles a lot and I'm really good at networking. And that's how I got to where I am today. So yeah, I closed on my first deal August 2021. It took me 2 years to build up my relationships, my network. I didn't have everything, and you don't have to have everything either. You don't have to have all the money. You don't have to have the deal. You don't have to have the net worth to sign on the loan. There are a lot of different ways to get into your first commercial asset, but you have to understand what you're looking at first. Because people, I don't know what everyone's experience in here is, but somebody comes in and tries to talk about flipping houses and they don't know what a roof shingle is. You can smell it out pretty quickly, right? So understanding commercial real estate is by far the most important part. And I think commercial real estate is the most powerful asset class that you can invest in, period. Amanda does mobile home parks. Randy does self-storage. I do apartments. And Karen, right? Karen?
Yep.
Karen does development with her husband, right?
Yep.
Those are all amazing commercial real estate asset classes. And what I want to show you today is the power of commercial real estate and how one deal can change your life, right? It took me 2 years of working 16 hours a day between my day job, which was a very highly stressful day job, managing a whole group of people, reporting to the CFO and the CEO of a huge publicly traded company. So I'd wake up at like 5 o'clock in the morning and I'd read and I'd learn and I'd underwrite deals. And then I'd do my day job and I'd be taking phone calls during the day with investors and brokers and knuckleheads like Randall, trying to just build connections and build those friendships. And then after work be done, I'd work till 10, 11 o'clock at night at 6, 7 days a week. I mean, I wanted it that bad. And you have to identify your why. My why originally was I wanted chasing money freedom, right? I don't work for free. As I started to attain that money freedom, I started to learn that it wasn't really money I was after. I was after the freedom, the time freedom that I could get from investing all these activities, right? I don't want to work forever. I know that I'm inherently a lazy person, so I'm going to find the easiest way to do the most difficult task. Okay. And that is commercial real estate. That is the most difficult task you probably will face in your professional business. But once you set up the systems and you have the relationships with people that are doing deals, my God, how much can you bring to the table and how much do you want to bring to the table will determine how much you own of that deal. And you can adjust if you want to be more involved, less involved. I mean, there's a whole lot of things there. I know that you guys I think most of you guys have a basic understanding of underwriting. But if any time I'm going too quickly, just stop and ask questions, right? The more interactive, the better. I can answer questions easily, quickly, to help you guys understand. So what I'm going to do is I'm going to bring up a deal that I'm closing this deal on Monday. I deleted all of the private information of like who's involved in this deal and the name of it and all that kind of stuff. But this is not a made up deal. Like this T12 is real. These numbers are real. The money that we raised from investors is real money. We've been working on this deal and we're inching towards the finish line now, thankfully, because it's been a bit of a headache the last couple of weeks. So without further ado, I'm just going to share my screen here. So this deal started out in this spreadsheet. Let me know if this is too small. If you can see that. Essentially, this is what a T12 looks like. If you guys aren't familiar with it, hold on, I'm going to drag this over here. So this is what a T12 looks like, right? You have well, this was a T11. They didn't end up sending me a T12, but you have all your months.
Can you mention what does that mean? T12.
Yeah. So the T12 is a monthly breakdown of your income statement over the last 12 months. Stands for trailing 12. So I got this in November, so it should have been December 2020 through November 2021. You always have a rolling 12 months here. And what this does is it shows you all of the income and the expenses of the property and helps you build your pro forma. It helps you do your underwriting. It helps you build your business plan on how you're going to increase the value of this property. And that is one thing I want to show you, the power of why commercial real estate is the #1 asset, because it's not based off of what your neighbor's house sold for down the street. It's based off of how much can you get the income, the net operating income up to, because it's valued as a business. And that's the key important thing that I want you guys to understand here. And I want you to see the power of how powerful that is on such a small basis. So yeah, I mean, I'm not going to go through all this stuff, but basically I took this T12 with the salaries and the management fees and everything. And I did some highlighting because I needed to put it into a couple different buckets because this is obviously not organized very well, but I put it in here. So this deal started out here. They're collecting $564,000 a year. They have expenses of 240 with an NOI of 224,000. It comes out to be an expense ratio of 57%. If anybody in here does apartment buildings, 57% is really high. So part of the business plan was to reduce the expenses. We dove in, we looked at the insurance costs. I looked at repairs and maintenance, payroll, everything. I looked into here and I said, this should not be operating at such a high expense ratio. It should be kind of somewhere in the 40 to 50% range, depending on how new the asset is and how high your rents are. So I took all that information and let me change to this screen now. And I put it in this. Okay. So this is the underwriting tool that I use in order to analyze my deals. It's called Synthesis from the multifamilyanalyzer.com. Hands down, probably one of the best tools, but I'm going to put a little plug in here for myself. I am building one myself. So I'm going to sell that one here in the future. That is going to be mobile home for Manda. It's for you. It's mobile home parks. It's going to do self-storage. It's going to do, I don't know how to do development, Karen. So I don't know how to build that in there, but it's going to do apartments as well. So I'm working on that right now with a developer, and he's working on making us a new file that fixes all the things that I don't like about this file. So I'm just going to skip right to the kind of the meat and potatoes on this guy. This deal, remember we started out with the T12. Those are your actuals. I brought in all the actuals. I put it all into the different buckets of real estate, of the taxes, insurance, electric, gas, yada, 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 yada. Okay. I took it and I analyzed what my expenses or what my taxes are going to be and what I can do for taxes and insurance and things like that for, for my team and my group operating it. The biggest one for us was we were able to negotiate down the property management fee. They were paying about 5 or 6% and $72,000 in payroll. So that's a combined total of, is that 100 grand? Yeah, 99,780. And we were able to renegotiate that contract down to 3% and $40,000 in payroll because it really only needed one person. And we reduced that expense down to $58,000. Why is that so important? It's so important because commercial assets are valued off of a capitalization rate. If we are able to increase the net operating income on our property by $40,000, I'm just going to do math here, right? So if I reduced it by $40,000 and I divided it by my cap rate of 5%, or it's really 5.5, so 0.55. Did I do that right? Let me just do 5% divided by 5%. I just increased the value. Yeah. Thank you, Randall. I just increased the value of this property by reducing the expenses $40,000. Wait, did I not do that right? The 800,000 or 8? Yeah.
So you're right. 800. So it's 40,000 divided by 5%, which gives you $800,000.
I don't know why it came back.
400,000. It's hard. It's a little bit.
Oh, too many zeros. Yeah. All right. So by reducing the expenses by only $40,000 on 2 line items, I was able to increase the value of this property $800,000. Okay. The power of commercial real estate is it is valued off of this bottom line here, your net operating income. It is so important to focus on that because if you can increase your income and decrease your expenses and you force that appreciation through your NOI, they don't care about the building next door like single family houses do. They care about how much money does this business operate or does this business produce? And then a capitalization rate is determined by the market. And you just pull that from the market and say, this is the new value of your property. So we bought this property. We got it under contract for $4 million. We're going to do about a $500,000 rehab on it. It's 31 units in South Carolina, Charleston, South Carolina. Current rents are about $1,600, and a property, we close on it on Monday, and current property management company just told me that they renewed a new lease at $1,800. And that was my 2-year pro forma number, was that I was going to get to 1,800 after putting in 500,000. So this deal is going to be a huge cash cow, because it's completely beating all of our pro forma numbers already, just because of what's going on in the Charleston market. I'm not going to say I'm God. I don't know everything about real estate, and I didn't make this happen. The market is definitely helping us with this deal, with the way that rents are going and things like that. But that's why it's so important for you guys to get into commercial assets as soon as you can, because as you ride this appreciation wave with inflation and long-term low interest rate debt and hyper growth of rents to keep up with inflation, the value of your property is going to literally skyrocket. Okay. We bought this property for $4 million. We're going to be all in for $4.5 million. And in 2 years, it's going to be worth $7.5 million. It's created $3 million of equity in 24 months. I mean, that's a huge, huge payoff. How many houses do you have to flip to make $3 million? A lot, right? Quite a lot. Now, this isn't as good as a development deal. I know that, you're building all of the value right from the ground up, which is important. But if you can find apartment complexes that are under rented and like their expenses are too high, you're going to be able to go in and significantly increase the valuation of them within 6 to 12 months or 24 months, depending on your lease schedule and all that kind of stuff. But this, in the commercial real estate apartment world, this is only a 31 unit property, guys. That's not a big property at all. I mean, people are buying 2, 3, 4, 500 unit complexes. 31 units is considered the junior leagues, but look how much money you can make in the junior leagues. This cell right here says that over a 10-year period, and this is conservative underwriting, with cap rates decompressing, that we're gonna, have more expenses than what we think. I mean, very conservative underwriting. It says that total profits to the managers are going to be $6.2 million over 10 years. Do you think it's worth your time to learn how to underwrite these commercial deals and build your networks and build your relationships with people that find deals? Yes, absolutely. I probably don't ever have to work again in my life, but I want to, because it's fun. I like making money. It's my favorite hobby. And yeah, I mean, I think, we kind of went over the P&L. I mean, the current rents are at 1,500. We're already getting 1,800. So this is probably going to be more like this, if we could follow this trend. And, we're looking at, $7 million of profit. I mean, it's insane, because it's the power of leverage with the ratio, net operating income, which is huge. Maybe what I should talk about now is how we structured this deal, and what do the returns look like for our investors, because that's important.
Can we, before we get into that, does anybody have any questions on anything on here so far? Net operating income, how you got that value, how you showing, 7 million, or any questions so far?
Can you hear me?
Yep.
Okay. Yeah, you have an 89% with your LTV. Can you explain your financing? Because normally it's, not going to be better than 80-20. Excuse me. It's not going to be better than 80-20 with new financing. So can you comment on that?
Yeah. So basically, we got this under contract for $4 million, and this loan to value is, I would agree with you here that it's not a proper calculation, because the valuation is based on the appraised value. This formula here, looking at it now, it looks like it's just based off of the purchase price. So we got 21% of the down payment financed by the bank, and 79% of the rehab financed by the bank. So 79% loan to cost at 3.5% interest with 18 months interest only. So we got a purchase price of $4 million, 21% there. The bank is financing $840,000. We got a rehab budget of $530,000, and they're financing 79% of that. So the 840 plus the 418,000 financed by the bank. Wait a second. Why does that? Oh yeah. So that's towards the purchase price and towards the rehab. And then we're also raising from investors the closing costs and the reserves. So the total loan that we got from the bank is 3 million. It's a little, the rounding's a little bit off, but the total loan amount is $3,575,000 even. And this loan to value is not even really correct because that's on the purchase price. It's not on the appraisal. We bought this, we just got the appraisal back yesterday and it appraised at 5.9 million. So
Oh, wow.
yeah,
That's
we're
good.
walking into like $2 million of equity day one.
That is excellent. The other thing is this going to have a full-time property manager?
No, because it's only 31 units.
Okay.
Full-time property managers are usually about 70 or 80 units and above. But we do buy all of our property in the Charleston MSA for the most part. And we have economies of scale there now where we have so many properties with one property management company. They hire a full-time property manager for just our portfolio of properties. And that reduces our expense across the board for all properties that we have.
So
right.
Functionally, if I were a tenant or I were a potential tenant, are you going to have one of the units on site that's going to be an office, or will someone go and put in an application at one of your other properties?
So the property management company that we're using is actually like a 1/10 of a mile down the road. This property is too small to have its own leasing office and we won't build it. Anything less than like 70 units or so, it doesn't, maybe even 60, 50, you could probably get away with 50 to 70 units and up having an on-site leasing office. But anything smaller than that, it's typically the property management company has to be local and they'll travel to the property, meet people there, or they'll have people come into their office, their leasing office.
Okay. That's
what
good.
we're also seeing now though is as we're starting to buy bigger properties in that area, we can utilize the leasing office from one property and say, hey, meet us. We hire a full-time property manager, property management company, and the property management company hired a full-time employee for our portfolio. So if anybody's applying to rent at one of these properties, if another one has an on-site leasing office, we'll just send them there.
That's good. I mean, that maximizes the scale of efficiency for you.
Right. And what most people will tell you is that you shouldn't look at anything less than 80 units because of that on-site property management piece. But one of my mentors told me, and this kind of blew my mind, of all the properties in the whole United States, 51 units and up, there's only 200,000 properties in the whole United States, like as of a couple of years ago, right? Obviously that number changes all the time, but between the units of 5 and 50, there's 600,000 properties. So where do you think you're going to find more opportunity? Definitely, this is like my third deal that we've done that's 31 units, and I'm okay with it because we keep adding to the portfolio and our costs get lower, and it's kind of like exercising a muscle. It just gets easier and easier and easier as you continue to grow and capitalize on that scale, that factor of scale.
Okay. Thank you. That's good.
You're welcome. No, thank you for the question. I appreciate it.
Hey, Tim.
Hey.
This is Constable. I'm sort of new to it. How should I be thinking about it going forward in finding a 5 to 50 unit property?
What are your goals?
Well, I'm sort of new, so I'm still formulating it. And so I'm trying I'm thinking about looking at the 5 to 10, because I was sort of doing some research, and a lot of those units I'm seeing is usually older, I guess, landlords who might not, the kids won't probably take it over, and they're getting to that age. I'm looking at those properties that are 10 and to 15 years that the one owner had it, and thinking there might be an opportunity, but I'm still trying to formulate how should I kind of go forward.
Well, do you mean that in terms of underwriting the deal, or in terms of marketing for the deal, or raising money from investors? I mean, it's kind of too broad of a question to answer.
Okay, so how should I think about it? Should I just, because I hardly know anything. And so underwriting, I just sort of dropped in. So I don't really understand
First of all,
the whole knowledge range.
where I might recommend you start is learning the different asset classes in commercial real estate
Okay,
and picking one that you feel compelled to, that draws you in, and then learning as much as you can about that specific asset class, underwriting being one of those things.
Yeah, so kind of to echo what she's saying is that's the clear and obvious answer for you of what to think about is education first, right?
okay,
Like I said, it took me 2 years of working 16-hour days between my day job and building my real estate education and network to be able to start doing deals left and right. On this deal, we had to raise 1,338,000. We ended up raising 1.4 million in 4 days from a handful of people. And that's only possible because I spent the time educating and networking with people.
Yeah.
And
Right.
it's a good deal and you have a good relationship with all these people, et cetera, and so forth. But the foundation is always education. And then once you have your education and you understand what you're looking at and you're interested in it and you're committed to doing it, that's when you build your network and start reaching out to people that are doing what you want to be doing. Get in the right rooms. I talk about it all the time with Randall is proximity's power. The closer that you can get to people that are doing what you want to be doing, the faster you'll get there.
Okay.
But if you don't have the education and you show up and are just like asking questions that, you could get from the answer from a book, they're going to smell through that and say, oh, you just want me to give you all the answers without you doing any of the work first. Right. So that's what I'm
Right.
saying. The education is
Okay.
always the foundation. So read as many books as you can. The first one that kind of catapulted me into multifamily was David Lindel's Multifamily Millions. If anybody's read that, a very popular book.
Okay.
Then there's Crushing It in Commercial Real Estate from Brian something or another. It's a bright
Sure.
red book. There's so many commercial real estate books out there and courses out there that
Okay.
that's absolutely what you want to start with first in order to learn and get comfortable with all the asset classes, how to look at the properties, knowing what all the terminology is. I mean, it's like a whole new language. So you have to commit yourself to learning it.
Okay. All right.
Tim,
Thanks.
would you say that it would, I don't know how you went about raising equity,
Mhm.
but a lot of people say, find the deal and the money will come, but
Mm-mm.
then you're under an intense amount of pressure if you
Right.
do it that way. So when you go into commercial real estate, if you can find someone like you, for example, and, be part of maybe the passive investor side and sort of come along beside someone who's already doing it, that helps too, because then you see how important to find the equity, the due diligence, all of those pieces are, and you don't get overwhelmed. You
That's right.
get to where you want to be.
When are you going to come out with a book? You know it all. No, absolutely. I mean, you literally said everything that everyone should know, right? And I tell everybody the first deal that I ever did was as a limited partner, as a passive investor. But I told them up front, it was like, hey, I know who you are. I've been following you on social media. I see what deals you're doing. I've been watching your deals and I've been learning and I've been underwriting and I understand what a good deal is. And this looks like a really good deal. But I'm not the investor that's going to write you a check and then just say, all right, cut me, my quarterly dividend checks. I want to be involved as a limited partner. I'm investing with you because I want to learn.
Right.
And what happens when you set the expectation with somebody and you say, hey, I'm going to cut you this check, but it's because I want to be involved. I want to be able to walk on the property. I want to, maybe be involved in some phone calls. I want to be able to kind of text you and talk to you a little bit about what decisions are you making and why. But before you can even invest as a limited partner, you have to know how to underwrite the deal yourself and identify a good deal, right? I mean, because guys, all I have to do here is change this number to a 4 and holy mackerel, like this is the best deal I've ever seen in my entire life, right? I mean, there's a level of trust there that has to be built with somebody that you're going to invest money with. And that's why I spend a significant amount of money going out to events, like shaking hands with people, going out to lunches and dinners and all the type of networking events that you can do, because you have to invest in other relationships with people in order to be able for them to trust you to put their money into it, right? The way that it typically works is there's the operator, then you have the deal, and then you have the market. Or actually, the operator, the market, then the deal. People invest in the operator always. They don't invest with just any Joe Schmo off the corner of the street. They want to invest with somebody they know, like, and trust. That's the whole point of social media, right? You make a social media account, you become a leader in the industry. You have a platform where you can talk about what you're doing on a day-to-day basis, and being omnipresent, showing up every single day. People are going to associate you as the expert in the field. And even if you've never done your first deal, they're going to at least start to reach out to you and ask questions. And once you start asking questions and you build relationships with people, you can start raising money for other people's deals, and then say, hey, well, look, I know that I don't have experience doing X, Y, and Z, but leverage the power of your partners, right? Bring in your partner's experiences and say, I'm learning from them. All I'm doing is connecting you with them for the deal, but I'm going to be involved in this. I'm part of the active management of this deal. I'm boots on the ground or whatever. And that's the way I got my foot into the door, to be honest with you. But yeah, you hit the nail on the head, right? I mean, it's all relationship based. I have a lunch next week here in Wilmington with a guy that just sold a huge piece of property. And he said he wants to cut me $1 million check as soon as possible, because he needs to get the money out of his account or he's going to spend it. Right. And that doesn't go far in the boat world.
That's a nice problem to have.
Right. Great problem to have. So I got 3 deals that we're working on now. There's another one in South Carolina, and I got a 100-unit property in Charlotte that we're closing on later this month. And hey, man, if you want to put $1 million in here or 500,000 in each one of these, let's do it. I think that syndicating apartments is one of the greatest things that you can do to help other people. And what do I mean by that? A 506B syndication cannot be advertised online, right? It's not social media. It's just for friends and family. You know the saying, the best deals get done behind closed doors. The 506B syndication is that. I feel so compelled to helping other people achieve their own financial goals. And the vehicle that I do that with is commercial real estate. Do I make money in between? Of course I do. Like, nobody can work for free. And I make good money out of it too, right? Because if you think about it, Elon Musk said it best, is you get paid in the proportion of the problem that you solve. If you can help hundreds and hundreds and hundreds of people achieve their financial goals way faster than some financial analyst can by putting their money into the stock market, getting 5 or 7%, and I can give you like 15 to 20% average annual return, who do you think they're going to keep coming back to put more money with, right? I think it's absolutely powerful what you can do. You can change people's lives, and people in your life need you to learn these things so that you can help them.
Yep. Great.
Any other questions?
Tim.
Yes.
So my question is about property management percentage.
Okay.
When you negotiated that, what's the range you should look for when dealing with property management percentage wise? Is it because you have a great relationship that you got that down to 3%, or what should I look for, or as a guideline for that?
Yeah, so general guideline, if you're kind of in that 10, if you're like kind of like 25 units and under, you're going to be around 9 or 10%. Pretty standard, like it's a lot of work for them to do that kind of stuff. The economies of scale really kick in as you get into 30 units and up. So if you're doing something that's 30 to 50 units, you might be able to negotiate 6 or 7% management fee. If you're doing something that's 70 units and up, you'll pay the property management company like 3, 4, 5%, but then you pay for the payroll, right? So it kind of offsets there. The reason that I was able to negotiate down to 3% on this property was because we have other properties in the area. So we're taking on payroll, right? Our 3 properties split up one person. So each one of those properties are bearing the load of the full-time payroll, which is like 50 grand a year or something like that. And then the property management company, they still make a fee on top of that because they have to manage that employee and they have the systems and all that kind of stuff. So yeah, at first it's going to be tough. Your expenses are going to be higher, but as you continue to grow and scale, you get those economies of scale and it starts to even out and slow down. And then like I have a really great relationship with these guys too. And real estate's all about relationships. I mean, people invest with and do business with people they know, like, and trust. Right. So if you just keep that in your mind, you're going to go far.
Sounds good. I appreciate it.
Yeah, absolutely. Great question.
So Tim, was this an off-market property or
It was.
did you? Okay.
Yeah. So the way that I found this property was the property management company that manages all of our other properties. They were managing this deal since it was built in 2008. Quick backstory on this. It was built in 6, 7, and 8, and they're all 31 townhomes. They're 3-bed, 2.5 bath. They were built to sell individually, but 2008 happened and he got foreclosed on. So he couldn't sell them off individually and just kept them as a single parcel of townhomes. So they're all like 1,800 square feet. They have wainscoting in the entrances and crown molding in the living rooms. And we're in the $500,000 budget. I think I broke it in here. I didn't, but we're putting in like brand new granite countertops and high-end stainless steel appliances and like all like really top end stuff. So that's how they've been managing it since 2008. And in their contract, they said, if you ever go to sell it, we have first right of refusal to buy it. And they were like, hey, Tim, and my partner's name is Tim too. So he's like, hey, Tim and Tim, do you guys want to help us do this deal? And we came on early January and I did all the underwriting. I connected everybody for the legal, for the securities work, for the insurance, for the lending. And me and my partner, Tim, we raised all the money and we helped them close the deal. So I didn't find it, right? Truthfully, I can tell you, I've never found a deal. Deals seem to come to me because I do the underwriting. So a lot of people think underwriting isn't sexy, but I think it is because I've never looked for a deal before. I think I've written up like 3 LOIs ever because I was trying to find a deal, but my partners and other people bring deals to me because they know I can connect them. But yeah, so actually, you know what? I should bring up a picture. Hold on, let me just bring up a picture of this deal because you're gonna see it and be like, wow, that's really nice. Yeah, well, you're gonna see the information. It's all right. We're closing on it anyways. How do I share the screen? So here's like the investor pitch deck. There's my company logo and my partner Tim's Harvest Properties. Just some information. Like they got, each one is a townhome with 3-bed, 2.5 bath, 1,700 square feet. It's got an attached garage, vaulted ceiling or coffered ceilings, wainscoting throughout the first floor, crown molding. I don't really love the brown cabinets, but like we don't really need to paint, like they're really high quality. We're just going to go in and put like a brand new granite countertop because it's not a little laminate and it's not granite. I don't even know what to call it. It's not like a really whatever. These were built to sell. So we were going to, sell these, but just going in a fresh coat of paint, which this one's already been done, and cleaning it up a little bit. And I mean, this property's got to be by far my favorite one that I've ever done just because of the condition of it. So, I mean, any questions on underwriting? I mean, I think I touched on like kind of the most important pieces of how the properties are valued and how we are capitalizing on the economies of scale, despite what some people will tell you of that, you have to go big. You don't have to go big. What you need to do is you need to build your network. Find people that want to invest money in commercial real estate, because there's so much opportunity out there between all of the different asset classes, not just mobile home parks, not just self-storage, not just apartments, not just warehouses. I mean, there's so much opportunity out there, and it is one of the safest investments that you can make, because if there is another recession or, the home values start to go down and people start to lose their homes, Where do they go? They put their stuff in Randy's storage place and then they come rent a unit from me, right? Mobile home parks and self-storage and apartment complexes are not going anywhere. It's the safest investment you can make, on top of which you can accurately predict what your future value is going to be. Now, you are always going to have to test things. The rents could maybe not go as high. They might come down a little bit, or cap rates will change, or your lending rate. I mean, there's always a little bit of wiggle room in there, right? And nobody's got a crystal ball. You can't predict it perfectly. But if you build in conservatism and you're staying up to date with what's going on in the markets with interest rates and rent rates and expenses and insurance and like all those different kind of things, then you can pretty accurately predict how much money you're going to make on a property over a 5 or 10 or 20-year basis. 20 years is a little too far out to estimate, because that's really far out. But a 5 to 10-year basis, you should be able to come within a couple $100,000 of what your profit's going to be.
What are your investment parameters, like internal rate of return, cash on cash, that kind of thing?
So I always underwrite to 2x equity multiple in a 5 to 7 year basis. So on a 5-year basis, that's a 20% average annual return. On a 7-year basis, I think it's like 16% or something like that, whatever, that's typically what I underwrite to. The other part of it is I only do value add multifamily. And here's why. I believe in the velocity of capital. The faster that you can get your original capital back and reinvest that money while still maintaining your original equity position is how you build wealth, right? You need to figure out how to take that money and put it back to work multiple times. So deals that I've done and I've invested in, and they're starting to do those refinances now, but I still own that equity piece, and it might be small, whatever, 3%, 4%. But now I can take that $100,000 and go put it back to work, and it's going to keep double dipping and triple dipping on my original investment. So when I do my underwriting, I always look for something that I can refinance in 2 years. So if I can return 70 to 80% of your money within a 2-year basis, and then sell it in 5 to 7 years and get a 2x equity multiple, I'm going to do that deal.
So does that mean that you're doing like a bridge loan or an interest only, or?
Yep. Yeah. Most of the deals all of the deals that we've done, except for this one, they're all bridge loans. This one was a really good, we have a good relationship with the bank, and we were able to negotiate 18 months interest only at 3.5% interest, but there's no prepayment penalties as long as we refinance into their bank again. So we borrowed their money. They gave us the rehab budget, 3.5% interest only for 18 months. And then we don't even need the money that long. I mean, 14 months, we could go and refinance this property and return everybody's money back. So we just made sure that there was no prepayment penalty, but everything else is traditionally a bridge loan that we refinance in 24 months. And there's always an option to extend an extra year. So it's called a 2+1 loan.
Recourse or non-recourse?
Always non-recourse.
Okay. That's
Always
good, especially with a bank.
Yeah, always non-recourse. You just never know. I mean, and something could happen. And if you go with a full recourse loan, I mean, you could lose literally everything. And there's inherent risk with real estate. And what's the mitigation of that risk is by paying a higher interest rate. So that's why it's so critical to make sure you know how to underwrite deals. If I go with a non-recourse loan, which is the benefit of everybody, but the downside of that is their interest rate is higher, can I still meet my investor returns? Right. And as long as you know what your investor returns need to be, and you can back it up and use all the information that you have, then absolutely go non-recourse every time.
That's good, because a lot of times banks tend to be recourse.
Yeah. Yep. No, and they'll tell, like this one, they said that they could do better interest rate than the 3.5. And I was like, but they wanted recourse. And I said, I'll pay a 0.5 point higher for non-recourse.
Oh, awesome.
Hey, Tim, Martin typed the question. He says, do you have to present your underwriting spreadsheet to your lenders when qualifying for your financing?
Yes, absolutely. Because commercial assets are always backed off of the debt service coverage ratio. So the bank is going to underwrite the deal themselves, and 80% of the loan is going to be backed by the deal itself. I'm unemployed. I can't qualify for a traditional a loan for a house because I don't have a W-2 job. But I can go sign a $5 million loan tomorrow for no problem because it's backed off of the asset. How much cash flow does the asset make? So yes, you always need to provide the T12, the rent roll, and your pro forma underwriting for the bank to underwrite. They do their own underwriting, and then if you guys are in the same ballpark, that's when they'll tell you what they can do as a loan product.
So just FYI, in some of the other asset classes, especially in the smaller assets, you may not even be able you may not have to show the lender exactly your underwriting. They may not ask for it. You may be in a recourse loan where you're personally guaranteeing it. And for some of these, especially some of the mom and pop mobile home park owners, they don't have P&Ls. They don't know their numbers. They can't give them to you. So you're kind of making up with, estimating what you know to be true. And then they'll have an appraisal on the property, and that will suffice instead of underwriting. So it really depends on like how big and the asset class and stuff like that, but it can vary.
Right. And, one thing to understand here, guys, is underwriting is a fluid document. When you first find the deal and you underwrite it, you're making a ton of assumptions. As you start to get more concrete evidence, like your insurance quotes come back and you get the estimate from the county of what your taxes are going to be, and you have the conversation with your property management company of what you can do on the rents and what their expenses are going to be, it's a fluid document, right? You're going to have to make some assumptions with some rules of thumb and then adjust along the way as you're going through due diligence and having conversations with the bank even, right? I mean, they have their own assumptions that they're going to make, which I don't agree with, but that's how they underwrite their deals. And it's just having a conversation with your bank to know what they underwrite to and how they're underwriting, because it's critical to understand how the bank is looking at the deal. The bank is your number one investor. They give you 75 to 80% of the deal. So maintain those relationships with your bank.
I would add on there, Tim, that's such a good point. To make sure you're finding a lender who has underwritten currently on their portfolio a type of property very similar to what you want to do. I wouldn't go with a lender who says they can do it, but they haven't done self-storage yet. Don't waste your time, because the salesperson that you're talking to, the lender, they're essentially a salesperson, and they aren't the ones, they're not the underwriters at the bank.
Right.
And the underwriters are the ones who say, yes, we're willing to take this risk, or we're not at the end of the day. So just make sure you're finding lenders that already have similar properties to what you're going to underwrite, so you're not wasting your time. And then you could have the money pulled out right before closing.
Yeah. And then another thing to back up what Amanda said was, don't use anybody unless they've been referred to you. There are so many predatory lenders out there that seem as legit as they can. Reach out to me, reach out to Randall, reach out to Amanda, reach out to anybody in this room and ask for, hey, can you send me a lending broker or an insurance broker or somebody that you've used and you trust? And I know who, I talk to them daily almost. And I was like, I know exactly who I'm going to send you to, and I trust them. Funny story, actually, my insurance broker on this Groden deal, he couldn't get the insurance policy that I wanted, but because I bring him so much business, he went outside of his own brokerage, called another brokerage, got me an insurance policy that was $8,000 less than what he could do. At a 5% cap rate, he just made me $160,000 by reducing my expenses $8,000. I sent him like a $250 bottle of bourbon. But that's relationship building right there, right? I mean, that's a thing. Like, he went to his own financial detriment to do that. And I will refer him a million times over because of it. Oh, cool. Awesome. This was fun. I get so pumped up talking about this stuff.
Well, do y'all have any other questions for Tim?
I was getting ready to say, Tim, if they wanted to reach out to you or get in contact with you, how will they be able to do that?
Yeah. So if you're interested, go to my website, www.upsidecapitalgroup.com. Or you can come on my Facebook group, Making Moves in Multifamily. Every Tuesday at 10 a.m. Eastern, Tim and Tim go live and we talk about what's going on in our businesses, or we interview people like Randall. Amanda, I got to have you on the Making Moves show. You can talk about mobile home parks. We just bring value to people. You interview attorneys and insurance brokers and other people doing different asset classes, because knowledge is power, and I lead with value first. So if you're interested in learning more, you can always join my Facebook group, or go to my website, upsidecapitalgroup.com. I got a portal in there where you can see all the deals that we have available for investment, if you are interested in investing as well.
Tim, thank you. This has been phenomenal. We
Thank
really,
you.
really appreciate it. I personally want to get you down to my Wilmington meeting because we have an NC RIA down there every month.
Do you
So,
really?
yeah, we meet at Waterman's down there. So
Oh, okay. Yeah.
I'll get you offline on that. But thank you so much.
Yeah, I'd
Um,
love to. I mean, if let me know how I can provide value. Happy to help out wherever I can.
Well, we really appreciate it. I think we got some valuable information. And, you know, if anyone has any questions, just reach out. If you can't get one of us, Amanda or Randall know how to get up with us. So please just reach out, and thank you all for joining us tonight. Hope you have a great night.
Yeah, thanks so
Yeah.
much.
Have a good
Thank
one.
you.
Karen and Jackie, quick question for you. We had a couple of requests to get the recordings of these subgroup meetings. Is that something like, and I know I mentioned that before and it sounded like it was more difficult, but I mean, I know when I record stuff, it just comes right to my email after the meeting. Is that something where we could maybe send it out to people who registered for the event only or something like that?
Jackie, do you know how that works? Because of us all having access to this and the recordings. Hello, Jackie. There you
Sorry,
are.
guys, you know what, I'm flipping and I'm on the phone with a contractor. I'm so sorry, and it's sort of a big deal. But what
Oh,
was it?
sorry.
Hold on one second. Hold on.
No, we can, I'll get it later. You go ahead, Jack. We'll
No,
figure it out.
that's okay. It's just a
Can
condo.
we get copies of the recording to, Amanda's asking, can we get copies of the recording to the ones that were on tonight?
That registered, yeah.
That registered, we should be able to. I think part of it is we've got to get the recording and we've got to transfer it over.
There could be a link and a password, right? Like that gets emailed out. We can figure this out. I'll email you about it. I've had several
Okay.
people ask though that can't make this time. So we'll see if we
Okay.
can make that happen. I'll email it to
Yeah.
you about it.
Yeah,
Cool.
reach out to me, Amanda. I'll try to figure it out. Part of the